All right, let's dive right into this explainer and see if we can demystify some of the intense anxiety surrounding the 2025 and 2026 stock market using some truly time-tested wisdom. Look, right now, there is a lot of fear circulating out there. People are looking at the financial landscape, seeing some pretty strange behavior and wondering, how do I actually protect my hard-earned money? Well, to find some clarity, we don't really need a crystal ball. What we need is to look at the strategies of someone who has successfully weathered literally every financial storm of the last half-century.
And when it comes to track records, well, the numbers absolutely speak for themselves. While the broader S&P 500 has seen a highly impressive 39,000% growth since 1965, Warren Buffett's staggering 5.5 million% return firmly establishes him as the ultimate authority on navigating market chaos. He basically achieved double the return of the market year after year just by remaining fiercely rational when everyone else was getting emotional. So how does his timeless advice actually apply to our current moment?
To figure that out, we have to look at the landscape and ask ourselves a really crucial question. Is the market overvalued right now? I mean, we're seeing AI stocks like NVIDIA hitting record valuations, recently becoming worth more than all the major banks in the US and Canada combined. And on top of that, US debt, both private and governmental, is just rising exponentially right alongside emergent competition from China and BRICS nations. So we're going to break down 4 specific warning signs in today's market, and we'll pair each one with a classic Buffett rule to help you navigate it.
Okay, let's jump straight into our first pairing. Warning 1, the surge in debt versus Rule 1, buying a business.
For the last 30 years, stocks bought using debt have vastly outpaced actual, organic market growth. This heavy reliance on borrowed money artificially inflates prices, kind of like blowing up a balloon way past its limit. When there is more money injected into the market than there organically should be, it leads to massive volatility. In fact, recently, the VIX index, which measures expected market volatility, spiked by over 30% in just a single month. That is a glaring signal that investors really don't expect the market to calm down anytime soon.
So to counteract this fear and artificial inflation, we have to apply Buffett's first rule. And to do that, we use an incredible analogy he borrowed from his mentor Benjamin Graham, the concept of Mr. Market. Imagine you own a business with a partner named Mr. Market. He's incredibly obliging, but he's also, well, a little manic-depressive. Every single day he offers to buy your share or sell you his, based purely on his wild emotional swings. Our job? Ignore the manic daily prices offered by Mr. Market, and instead rationally evaluate the fundamental business underneath. If you're just staring at a stock price all day, you aren't really investing.
Now, if you evaluate those underlying businesses and find that the overall market is indeed overvalued, where do you actually look? Well, defensive sectors tend to perform well no matter what the economy is doing, simply because they provide absolute necessities. We're talking about medicine, groceries, utilities, and your cell phone service. People just do not cut back on these things even when the market gets scary.
Moving right along to Warning 2 and Rule 2. Concentration risk versus your circle of competence. Let's see how this builds some real tension in our current market structure.
To put this definition into plain English, think of concentration risk like a group project in school where only 1 or 2 people do all the actual work. We've all been there, right? If those 1 or 2 people get sick or just decide to quit, the entire project collapses. And that is essentially what's happening in the S&P 500 right now.
Just look at how top-heavy things are. Just 10 massive tech companies, names like Apple, Amazon, and NVIDIA, now make up a full third of the S&P 500's value. That means the market is literally more concentrated today than it was during the absolute height of the dot-com bubble back in 2000. If those few companies stumble, they are going to drag down the entire index, even if the other 490 companies are doing perfectly fine.
Because of this intense AI-driven concentration, the S&P 500's price-to-earnings, or PE ratio, sits dangerously over 30 right now. To give you some historical context, the norm for this ratio is usually between 16 and 20. So hitting 30? That means it would take a massive 50% drop across the board just to return to those historical average prices. Things are incredibly expensive right now.
Which brings us to the crucial point of Buffett's second rule. Look, AI is absolutely creating real value, for sure. But we have to treat it today kind of like the automobile industry back in 1905. The car was undeniably a world-changing technology. But out of the 2,000 early auto companies that popped up, roughly 1,997 of them ultimately failed, leaving just 3 surviving winners. Trying to pick the ultimate winner of a brand new technological revolution is insanely difficult.
Therefore, the ultimate antidote to this concentration risk is to stay strictly inside your circle of competence. Only invest in the specific areas you truly understand, rather than just blindly following the crowd into incredibly complex trends. If you're a boat mechanic, stick to marine companies. If you're a software engineer, look at tech. You don't have to be an expert in everything to be successful. You just have to know exactly where the perimeter of your knowledge ends.
All right, let's head into warning 3 and rule 3, valuations versus a margin of safety. We're going to look at a pretty terrifying macroeconomic metric here.
Back in 2001, Buffett revealed what he called the single best measure of where valuations stand at any given moment. It famously became known as the Buffett indicator. This indicator is just a very tangible way to measure how much people are paying for companies compared to what those companies actually produce in the real world.
And right now, the warning light on this thing is flashing bright red. Why? Because this indicator is currently sitting a staggering 69% above its historical average. That is more than 2 standard deviations off the trend line. To put that into perspective for you, we have never historically sustained that level of deviation for more than 6 months without seeing a major market correction. Like I said, it is undeniably an expensive market.
So how do we survive a correction if one happens? Well, statistics heavily prove that simply holding through a market dip absolutely beats trying to time the market by actively buying and selling. But because we have to hold through that turbulence, Buffett's third rule dictates we absolutely must build a margin of safety into our investments to ensure we don't get totally wiped out.
To visualize this, picture yourself driving a massive 9,800-pound truck. If you're crossing a low bridge that's just a few feet above a creek, you only need a small safety buffer. That's like buying a stable, boring utility stock. But if you are crossing a bridge over the Grand Canyon, which is like buying a highly speculative, high-flying AI stock, you require a massive margin of safety. Because if you fall there, the consequences of failure are absolutely catastrophic.
And that brings us to our final pair. Warning 4 and Rule 4. Hyperactivity versus the punch card. Let's talk about how people are actually behaving out there.
Right now, we are seeing a massive spike in retail day trading, incredibly risky options trading, and a huge buildup of cash just sitting on the sidelines waiting to be thrown into the ring. Now, history shows us over and over again that a sudden spike in short-term trading, treating the stock market like a weekend trip to Vegas, is very often the final warning sign before a major market correction.
Warren Buffett perfectly summarized the danger of this constant tinkering way back in his 1983 letter to shareholders. He wrote, "A hyperactive stock market is the pickpocket of enterprise." He's reminding us that in investing, activity does not equal productivity. Constantly jumping in and out of the market just slowly eats away at your returns through fees, taxes, and inevitable emotional mistakes.
To combat this urge to constantly push buttons and make trades, Buffett's fourth rule suggests adopting what he calls the 20-punch card philosophy. Imagine treating your investing life like you only get a single card with 20 punches on it. If you could only ever pick 20 stocks in your entire lifetime, you wouldn't just buy a stock based on some random rumor you heard at a cocktail party, right? You would think incredibly carefully before using up every single punch.
In fact, there's a legendary story about a study at Fidelity that humorously proved this exact punch card theory. They looked at their accounts to see who actually had the absolute best returns over time. The second best group, people who literally forgot they even had accounts. And the number one best performing investors, dead people. Doing absolutely nothing, making one good decision, and just forgetting about it for decades is very often the best strategy you can possibly have.
So, as we wrap up this explainer, I want you to look at your own portfolio through this exact lens. Please don't let the anxiety of the upcoming market force you into bad, hyperactive decisions. Look at what you own, make sure you actually understand the fundamental business, demand that margin of safety, and ask yourself this final question. Do your current investments truly deserve one of your precious, lifelong punches?